G'day developers. Alright, let's get straight into it. We're talking about one of the biggest hurdles in any project, getting the right funding. I mean, it doesn't matter if you're planning boutique townhouses or a massive high-rise. Getting that finance structure spot on is what separates the projects that absolutely fly from the ones that just stall out.
And look, the opportunity right now, it's absolutely massive. Just have a look at this number. That's how many dwellings are under construction across Australia right now. We're talking a huge market, just brimming with potential, but only for those who get it right.
So with that much opportunity out there, the big question is, how do you get the funding to make it happen? But here's the thing, and this is what really separates the pros from the pack. It's not just about getting the money. It's about getting the right money structured in the right way, right from day one. That's how you protect your profit.
So, in this quick explainer, we're going to walk through the whole roadmap. We'll kick off with a funding hurdle, then dive into your financing toolkit. After that, we'll cover structuring your deal, navigating the tax maze, and we'll finish up with your final blueprint for success.
Okay, let's get into it. Section 1, the funding hurdle. And we're talking about looking beyond the big banks. You see, the first hurdle is always finding the right lending partner. And while, yeah, the major banks are still in the game, things have changed a lot. The real flexibility, the real action, it's often found somewhere else entirely. So, who's actually offering these loans? Well, you've got your major banks, of course, but the real story, the place you need to be looking, is at these other players. We're talking non-bank lenders, private funds, specialist finance groups, even JVs. These guys are often way faster, a lot more flexible, and they're willing to build a deal that's actually tailored to your project. Honestly, in today's market, having a network of these funders is a huge, huge advantage.
All right, next up, Section 2, your financing toolkit. It's all about having the right tool for the job. Let's have a look at how the main funding types stack up, because you've got to pick the right one for the right stage of your project. This table here gives you a really quick snapshot of your core options. You know, you've got your standard development finance as the workhorse, bridging loans for speed, mezzanine finance to add leverage, and JVs to share the load. But I want to take a closer look at two of the most powerful tools in that list, bridging and mezzanine finance.
Okay, first up, the bridging loan. I love this one. Think of it as your financial strike weapon. It is all about speed, all about agility. It's that quick hit of cash that lets you jump on an opportunity, one you definitely miss if you're waiting around for the big banks.
But, of course, there's a trade-off, and this slide lays it out perfectly. The pros, you get super quick access to funds, and often a high loan-to-value ratio, or LTV. The cons? Well, that speed comes at a price. We're talking higher interest rates and a really short repayment window. The takeaway here is crucial. You absolutely 100% must have a rock-solid exit strategy before you even think about taking on this kind of debt.
All right, next up is mezzanine finance. Now this is a really clever way to make your own capital work a lot harder for you. It's basically a hybrid of debt and equity, like a second mortgage, that can push your total funding up to maybe 90% of the project cost. And what does that mean for you? It means you keep more of your own cash free for the next deal. So what's the deal with mezz finance? Well, the big prize is that you retain full control of your project, which you just don't get in a JV. But, and it's a big but, it's not cheap. You could be looking at rates north of 20%. And lenders, they're going to want to see a shovel-ready project. That means you've got to have your approvals done, your costs nailed down, and a decent slab of pre-sales already locked in to de-risk it for them. Okay, so we've talked about what funding to get. Now let's move on to Section 3, structuring your deal. And this is all about asset protection and profit. Honestly, this part is absolutely critical for protecting your other assets and making sure your tax position is as good as it can be. So a tool that a lot of seasoned developers use is something called a special purpose vehicle, or an SPV. The best way to think about it is like a financial quarantine zone for each project. You set one up, and if that project goes pear-shaped, the financial fallout is completely contained. It can't touch your other developments, and more importantly, it can't touch your personal assets. Now, when you set up an SPV, you've basically got two common structures, a company or a unit trust. And this is a really critical decision. Put simply, a company structure is brilliant if you want to retain your profits and reinvest them into the next project. But if your goal is to distribute profits and cash out to your investors, a unit trust is generally way more flexible and straightforward. Right. Section 4. Let's talk tax. Navigating the tax maze. Specifically, capital versus revenue. And listen up, because this part right here, this is where tens, sometimes even hundreds of thousands of dollars can be saved or completely lost.
It all comes down to how the ATO sees your project.
And it all boils down to one simple thing: your original intention. What did you plan to do from the very start? The ATO wants to know, were you buying to hold it as a long-term rental or investment, or were you buying to develop and sell for a profit? That one distinction changes everything. If it's an investment, you might get that juicy 50% capital gains tax discount. But if they see it as a business of flipping, boom, you're taxed on every single dollar of profit at your full marginal rate. No discount.
And don't just take my word for it. The ATO is crystal clear on this. I mean, have a read of this. If you're carrying out a profit-making activity, otherwise known as property flipping, it's treated as business income. End of story. And that means the main residence exemption, yeah, that's off the table, even if you live in it for a bit.
And it's not just income tax, of course, you've got GST. Now, if your turnover is over $75K, you have to register. Simple as that. The upside is you can then claim back GST credits on your construction costs. The downside is you have to pay GST when you sell a new property. But the real key here, the thing you need to talk to your accountant about, is the GST margin scheme. It can seriously reduce your final GST bill, so get professional advice on that one early on.
Okay, let's bring it all together. Section 5, your final blueprint. So with everything we've talked about, what do lenders actually want to see? What's the final checklist for getting your finance application over the line and hearing them say yes?
At the end of the day, lenders are all about one thing: mitigating their risk. So your proposal has to be absolutely rock solid. Number one, they need a detailed feasibility study showing a healthy return. Think 15 to 20% on cost, minimum. 2, they want to see your track record. Have you done this before? 3, pre-sales. This is huge. It shows them there's real demand. 4, your delivery team. They want proof you've got skilled builders and architects on board. And finally, contingencies. Your budget has to have buffers for delays and cost blowouts. It shows you're a pro.
Because ultimately, getting the structure right, it's not just about getting this one loan approved. It's about building a proper framework for profit, for asset protection, and for your long-term success in this game. So the question I leave you with is this: is your current financial structure actually built for maximum profit, or is it quietly exposing you to a whole lot of unnecessary risk?